Hey folks, just gonna have a quick chat around mortgage interest rates. I've received a good few inquiries over the last couple of weeks and months in relation to mortgage interest rates. What do I think people should do? Should they fix or should they go on variable rates? Variable rates aren't an option in my opinion, and in fact the banks themselves are actually encouraging people by offering lower fixed rates than the variable rate at the moment. So to give you an example, the variable rate with Bank of Ireland is around 4% and their fixed rate over 3 years is about 3.15, 3.2. So obviously the fixed rate is the way to go. The reason being that the banks are doing this, guys, is that they want people to have security and know what they're going to be paying, obviously, over the kind of the long term. So if you get a 3.2% fixed rate, you know exactly what you're paying for the first 3 years, which is great comfort to the bank and obviously comfort to you to know what you're paying. What I will say to everybody though, and I get an offer message on this, I give everyone the same advice. If you are going on a fixed rate for 3 years and it's in around the 3% mark, I think ABC might be the lowest at the moment, the 3.1, whatever bank you're going to go at. If you are going for a fixed rate, just be very, very careful that when you come off that fixed rate in 3 years, 100% is going to be more expensive. The interest rates are linked to the ECB rates. The ECB rates at the moment are pretty much zero. So in the next couple of years, they're going to start increasing, in my opinion. I think it's going to start early next year. You're going to see a 0.25 raise in the ECB. What that means is when you come off your fixed rate in 3 years, you're going to have a more expensive rate. So the tip here is that what you should do is put a few quid aside each month. If you take your mortgage out next month, start a little savings account online, or the credit union. I love the credit union. I think the credit union is a great place to save. Set up a DD with the credit union and start putting in maybe 50, 75, 100. The more you can afford, the better. So let's say, for instance, you put 100 quid a month. If you have 100 quid a month, 1,200 quid a year, over 3 years, you're going to have 3,600, excluding interest, in an account. In 3 years, when you come off your fixed rate mortgage, if your mortgage has gone up, so if you come off your fixed rate and the rate's a bit higher and you have an increase in your monthly repayment, you can simply take money out of a savings account over the next few years. So if your mortgage gone up by 100 quid a month, obviously you've got 100 quid a month for the next 3 years, and that pretty means you've kind of sorted out your own fixed rate for another 3 years or 2 or 3 years after your fixed rate is ended. So that's my big tip for today. Make sure you set a little bit of savings account to take control of your own mortgage. And the other thing to consider is the ECB, when it does start to increase, just keep an eye on it. Just make sure that you're comfortable taking out your mortgage. That if your mortgage is going to be, say, 12 or 1,300 quid a month, like, if you can't afford maybe 18 or 1900 quid a month, you're going to be squeezed, maybe rethink, can you actually afford the mortgage? It's great paying over 3 years, but you have to think, what are the interest rates going to be in 3 years time? Years ago, when there were tracker mortgages around, people had some comfort, but there's no tracker rates anymore. So that means that you're going to be at the mercy of the banks and the ECB in 3 years. So just really be careful and consider that when taking a mortgage out. Thanks for watching. If you want to share this video, please feel free. Maybe like and tag a few people that need to hear this. Have a good day, folks.